So, the hot topic in the mortgage industry recently is the mention of a possible 50-year mortgage. And there's a lot of people for, a lot of people against. I'm leaning against myself. I could see some very, very small benefits to having a 50-year option for first-time home buyers. But honestly, I don't think it's a huge benefit. But I wanted to break it down to show the numbers of what it might look like compared to a 30-year fixed option today. So let me share my screen here. And first, we're going to look at today's mortgage rates. This is the Freddie Mac website, which you can come here anytime and get an idea of what rates are. And on average, we're at 6.23 as of the end of last week for a 30-year, and the 15-year is at 5.5. So they're about 0.75% different. Now, based on that difference, we can assume that a 50-year option would be higher than a 30-year option. No idea by how much. So I'm going to assume that it's going to bump up to 6.75, 6.75, another 0.5% higher. It's not quite double the term like it is from 15 to 30. So let's not increase it quite as much. And honestly, we have no idea what the rate would be on this, but I think it's safe to assume that it's going to be higher. So if we look at what the projection might be on monthly payment and principal paid over time on a 50-year versus a 30, I think that's what is going to be most important when comparing these. So if we're looking at a purchase price of 500,000, this person's putting 20% down. So not the average first-time home buyer, but this loan amount is roughly average of what we're seeing these days. So we're just kind of using this as a general comparison. We're going to plug in the average interest rate from the Freddie Mac side of 6.23 for the 30-year fixed, and then 6.75 for the 50-year fixed. The payment, you can see you save $127 a month by getting a 50-year term, which, I mean, that's not a small amount of money, but again, it is on a pretty large loan amount, probably more than the typical average first-time home buyer. Also, this is 20% down. Most first-timers are not doing that. The other piece of this puzzle is we have no idea the implications of monthly PMI on a 50-year mortgage versus a 30-year, because that too is impacted by the loan term. So I imagine the PMI would be higher as well. So without looking at PMI, it's only $127 a month savings. But if you look at the principal paid over the first 5 years, it's drastically different. You pay off 20,000 more in the first 5 years on a 30-year than you would on the 50-year, which is pretty significant because I think the idea with these is you want to get a 50-year and then refinance into a 30-year some point along the way. Well, you're really banking on that home appreciating at a pretty fast clip in order to have enough equity in the home to refinance and roll those closing costs into the new mortgage. As it stands, this 5,700 won't cover what it would cost to refinance. I'm going to put cost in quotes, right? Because there are actual closing costs, but then a big portion of the increase in your loan amount on a refinance is the prepaids, which is your escrows. Not really a cost if you ask me, because you're going to get a refund from your existing escrow. So it's kind of they break even almost, but still, most people are not bringing money to closing on a refinance. They likely would in this scenario, even after 5 years of living in the home, refinance and have to bring money to closing is not ideal. So again, the pro is, yeah, you're saving $127 a month, but I think the cons pretty heavily outweigh the pros in this case. Would love to hear your thoughts. Get back to me on your opinion on a 50-year mortgage. Are you for it? Are you against it? And then the other topic that maybe we'll talk about at another time is the idea of a portable mortgage, which that kind of excites me a little bit. It's very much like an assumable mortgage. Those today, they're kind of a nightmare to pull off, but if you can just take over somebody's mortgage rate on their home when you're buying it. Well, this works the same way, but instead you can take your existing mortgage, if it's a 3%, and put it on the new house you're going to buy. You just have to make up the difference in loan amount and sale price. The idea of that is kind of exciting. Who knows how it's going to pan out or if it'll actually become a thing, but I'm definitely more in favor of something like that over a 50-year option. Again, let me know what you think. Hope you have a great rest of your week. I'll talk to you later. Bye bye.